Now, Statistics South Africa released South Africa's GDP figures for the first quarter of 2019, and that revealed that the country's basket of goods declined by 3.2%, and this is compared with the fourth quarter of 2018. Mining and manufacturing data, which slowed this year, has been linked to the country's slow economic growth. Joining us to discuss South Africa's GDP results is Bianca Botes, a corporate Treasury Manager at Peregrine Treasury Solutions, and also Maarten, Ackerman, Chief Economist at Citadel. Welcome to the both of you.
Thank you.
So, you guys all got it wrong in terms of your forecasting. Let's get that out the way. It's okay because it was everyone, but by a big shot. So I'd just like to understand, in terms of your individual modelings, where you didn't, quite get it right to such a degree that it was such a miss. Can I be ladies first, kind of?
Yes,
I hope you don't mind. Maarten, Bianca.
I think initially coming into 2019, no one foresee the massive effect that load shedding would have on the country. Mm-hmm. And unfortunately, in the first quarter of 2019, we had massive rolling blackouts that ultimately has an effect on the amount of economic output we can deliver as a country. And unfortunately, that is something that you cannot forecast and you cannot budget for, you cannot foresee it. It ultimately comes down to the output capacity of Eskom and what is happening within the intricacies and the functioning of that company.
Mm-hmm. So load shedding having a bigger impact, particularly on the mining and manufacturing sectors, as these numbers are showing. But Maarten, for you, where was the miss?
No, I agree. I think, in the State of the Nation speech, the President said that, we shouldn't have a lot of load shedding, and since then we had quite a number of those up until the election. So that was an unexpected event. Through the quarter, looking at mining, manufacturing, retail data, we realized that it is going to be a bad quarter, and I think that's why the consensus was around about 1.6 negative, some people even as low as 2%. But then also, if you add to that, that's our own local issues that we've been fighting with. But globally, we also have a very soft patch in the first quarter, with everyone slowing, excluding the US. But a lot of the big manufacturers like Germany, Japan, and China slowing a lot. Other emerging markets. So global trade also took a knock. So the massive decline in our export number in the first quarter was also a bit unexpected. So if you add all of those things together, that's probably why we got to that 3.2, which was a shock for the market.
A shock. I understand, the worst in 10 years. Where to from here, though? Because I know everybody is expecting growth to tick up. You still sticking to your same forecasts initially before these actual figures came out?
No, I think given this deep decline, it will be quite a challenge to get to the, call it 1% that most people are expecting at this point in time. In the budget this year in February, they spoke about 1.5%. The Reserve Bank since then cut their forecast slightly lower. I think where we are right now, if you take into account the minus 3.2, my view is that it will be a challenge getting to 1%.
Sure, 1% a challenge.
2.5% for the next 3 quarters, which is good growth, we will basically get to 1%. So I think the expectation going forward, and we'll start seeing those numbers coming out, is probably closer to 0.5% if we're lucky for this year.
So I'd also like you to add to that, but also the fact that we've had weak data come out for the second quarter so far. I mean, your expectations for growth for the rest of the year, but also, are you not afraid that we could miss quite significantly in the second quarter, such that perhaps we get an unexpected contraction in the second quarter too?
Absolutely. I think one of the biggest risks still remains to be in load shedding and Eskom and our ability to actually produce electricity.
But touch wood or touch, I think this is kind of wood, we haven't had that so far in the second quarter.
Absolutely. And not to sound pessimistic, but the question you need to ask is, structurally, how different are we now from where we were a couple of months ago? Nothing has fundamentally changed. So the risk is definitely still there. And then, as Maarten touched on, global growth is slowing, and that impact on South Africa will also be significant. The other problem that we are facing is that we're really struggling from a government perspective and government policy in a structural reform to stimulate economic growth. The IMF concluded their visit to South Africa yesterday, and they once again pointed out, and it's starting to sound like a broken record, that drastic structural reform is required. And we haven't really seen that coming through. And hopefully we will see those policies being driven by the new cabinet going forward for the rest of 2019.
Yeah, I mean, National Treasury reacting to the IMF statement saying that we'll get more clarity on the kind of drastic actions that government plans to take at the State of the Nation address later in a couple of weeks' time, though. Interest rate cuts, everybody's talking about that being back on the table. We've seen the same trend happening in Australia. I was chatting to one of the guys in London saying, expecting the ECB to do the same. So how can South Africa not cut interest rates, and especially with growth, this paltry?
Yeah, I think since the beginning of this year, most central banks made a U-turn. The Fed was the first on the 20th of January that said they will wait. This afternoon, the Fed governor actually said that, you know, if this continues, then they might even cut sooner than most people expect. So globally, it's paving the way for us to think about cutting interest rates. But if you think about this weak growth environment, it is something that the Reserve Bank can seriously consider. There's also this afternoon talks about changing the mandate, where the Reserve Bank should focus more not only on inflation but also employment,
which we've
and
heard
growth.
in the ANC's manifesto. So now
That's
this is the politicians saying that, listen, this needs to happen because of, you know, how tough things are. So you also have the view that interest rates are going to go down next time?
I'm definitely expecting it to go down. Previously in the NPC meeting, they highlighted that they could even look at Q1 2020. But I think given the dire economic growth that we've seen in the first quarter, that could actually come to market quite a bit sooner than expected. I think one thing that we need to caution against as well is taking away the responsibility of stimulating economic growth from government, from fiscal policy, and merely pushing it onto monetary policy. Because even though you can stimulate growth using monetary policy, it should be a combination of both fiscal as well as monetary policy to ensure that there's sustainable long-term growth.
Okay, so in terms of fiscal policy that President Ramaphosa should be looking at maybe closely to stimulate the economy, what would your recommendations be?
Firstly, look at stimulating employment, and in stimulating employment, we need to attract for more foreign investment. Currently, we're not really seeing fixed foreign investment in South Africa. We're not really seeing fixed capital formation taking place. And as a result of that, we are lagging behind in actually creating employment. Youth unemployment is sitting at a shocking rate of 55%. Unemployment figures are the highest it's been, you know, and that's really not a record high to be bragging about. That is something that needs a very firm policy reform to actually start looking at that. And I think the first step to that is legislation. How do we change the labor legislation to actually make the employment market more dynamic to absorb employees easier?
Yeah, I mean, we're talking about attracting foreign investment, but these are companies that are also grappling with the fact that the global economy is slowing. So I imagine that they'll also want to be a little bit more prudent. I mean, what are the chances? And especially if these trade tensions there in the US do materialize even more, and even if President Ramaphosa walks the walk and does the things in terms of correct policy, what are the chances of capital, you know, investing more in South Africa?
I think if you look at the investment summit last year in October, you know, we've got a $50 billion pledge, so that's positive. But obviously what we need to do is rebuild trust and confidence. I think a lot of those commitments in terms of new capital, investors said, well, let's first see if Cyril Ramaphosa will be the man. Let's see what the election outcome is, who's in the cabinet, and then get clarity on a lot of policy uncertainty from Eskom to the land issue and property rights and. So if the new cabinet can really focus on those and rebuild confidence, you know, confidence normally leads everything. So you don't see a strong economy and then people start to feel better. It's the other way around. So I still think that capital, the possibility is there for it to flow. The challenge for us is we're in a global environment and we need to show that we're more competitive. And we moved back quite a bit over the past 10 years in terms of competitiveness. So we need to get that back in terms of what we put on the table.
What you're talking about, labor in terms of taxation,
all of that, yeah.
Okay. Guys, we are out of time, but thank you so much for being with us, helping us better understand the situation that we stay in the South African economy, and also what needs to be done certainly to get growth going again. I'm saying thank you to Bianca Botes, Corporate Treasury Manager at Peregrine Treasury Solutions, and also Maarten Ackerman, Chief Economist at Citadel.